Are you interested in options but don't want to spend a lot of time learning more about them? Let's learn options in less than 5 minutes. What's up, everyone? This is Eric with Theme Options Trading, and today we're going to discuss options. Options. What are they? There are two types of options contracts, a call and a put. A buyer of a call contract has the option or the right to buy 100 shares of an underlying at a specified price or strike price by a specified date or expiration date. If you long or buy a call contract, you have a bullish market outlook because you want the stock to go higher. What about a put contract? A put contract gives the buyer the right to sell or short 100 shares of an underlying at a specified price or strike price by a specified date or expiration date. If you long a put contract, you have a bearish outlook on the underlying because you want it to go lower. Let's now talk a little bit more about a strike price. Let's assume you have a stock trading at $105, but the call contract has a strike price of $100. This contract is in the money because remember, a call contract gives the buyer the right to buy 100 shares of the underlying. So theoretically, if the buyer executed the contract immediately, he would be long an underlying at $100 that is currently trading at $105. Okay, well, what happens if the strike price is the same as the underlying on a call? That means it's at the money. That brings us to our last term of out of the money. And out of the money is when the strike price is greater than the underlying price. And the exact opposite holds true for put contracts. Let's now look a little bit more about an in-the-money call contract. And we will assume a call contract is trading at $7. We will assume the strike price of the call is $100 and the stock is trading at $105. What is this $5? This $5 is the contract's intrinsic value. So $7 minus $5 is $2. What is this extra $2? This is the extrinsic value of the call contract. And this is the fee charged to the buyer from the seller for assuming the risk. Now, let's talk a little bit more about expiration date. One way to describe the expiration date is through DTE, or days till expiration. So if you see a call contract that says 4 DTE, that means 4 days until it expires. What happens after the contract expires? It either expires with value or not. So what happens if a contract expires with value? An option gives the buyer the right to execute his contract. So theoretically, if his contract expires with value, he doesn't have to execute it. And there are many reasons why he may elect to do this. Lastly, Greeks. Another important term thrown around in the options realm. There are 4 primary Greeks. Let's talk first about delta. Delta answers the question for a $1 move in the underlying, how much will the value of my contract change? This begs the question of, does the underlying move the exact same as an options contract? And the answer is no. Q gamma. Gamma is what makes options contracts value non-linear. What does gamma do? Gamma answers the question for the next dollar move, how much will my delta be affected? So let's assume you have a delta of 1. The stock moves $1 in your favor. What now could the delta be? Potentially 1.02. That 0.02 or the 2 cents comes from gamma. Now theta. Theta is time decay. Theta answers the question, how much value will my options contract lose daily? Options contracts are expiring assets, and this is the purpose of theta. Lastly, vega. Vega answers the question, for a 1% change in implied volatility, how will this affect my options contract value? As the name suggests, implied volatility is implied. It's what the market thinks the move is going to be on the underlying. Does the market think that there's going to be a big move? Well, implied volatility may be high. And that's it. You can go way more in depth with options contracts, specifically options trading. So if you like this content, I have much more content out there that goes way more in depth about the topics we just discussed and will definitely add value to your trading. Until next time.